Shares of GameStop have been trading at sky-high prices the past weeks, driven by an online community called Wall Street Bets. Why did this community target GameStop? Why did hedge funds short GME? And what lessons can we as investors learn? First, a quick introduction on GameStop. GameStop is an American retailer of computer games, consumer electronics and merchandise founded in 1984 and is active in the USA, Canada, Australia, New Zealand and Europe with roughly 5,500 stores as of February 1st, 2020. Taking a look at their latest financial statements, we can see that GameStop has been performing very poorly over the past years. Total revenue dropped, net income slightly increased but still remains very negative. Free cash flow dropped even further into the red. They fired up to 2,000 employees, leaving them with 14,000 full-time equivalents, and the amount of stores decreases every year. According to CNBC, more than 50% of the department stores anchoring America's mall are going to close permanently by the end of next year. This is partially caused by the impact of COVID-19 and a change in shopping behavior. GameStop specifically revealed its plan to close over 1,000 stores by the end of its fiscal year. As a result, many institutional investors have a bearish sentiment when it comes to GME and decided to short the stock. In conclusion, things are going downhill fast and change is needed in order to survive. In order to explain the short squeeze, we first need to understand what is short selling. By shorting, we refer to a transaction in which borrowed securities are sold to repurchase them later at a lower price and return them to the lender. Imagine you are the short seller. You go to a broker and borrow shares from him, which you sell to the market at market price. At a later date, you buy the shares back, hopefully at a lower price, and return the shares to the broker. To further illustrate this, imagine you get $100 from selling the shares and manage to buy them back at $80. This leaves you with $20 in profit. As you can see, this is only profitable when the share price drops. Hedge fund Melvin Capital was convinced that the stock price would decrease further and therefore took a massive short position. Reddit users on the subreddit Wall Street Bets, with more than 8.5 million members as of writing this article, noticed this and saw an opportunity to turn the tables on the hedge funds. If these members decide to bundle their buying power, they become one of the wealthiest players and can thus have great effect on the market. And so they did. So why did they target GameStop specifically? It's a combination of change in shareholder structure along with booming end-of-year sales and next-gen gaming consoles coming out that made those investors believe that it would be a turning point GameStop needed so badly. Thus, the small traders bought call options, betting it would rise. Since there is only a limited number of shares available for trade, the supply remained fixed while the demand suddenly spiked. As a result, stock prices increased. Going back to our example from earlier, have a look at what happens when the price increases over time. Now the short seller has to buy back the share at a higher price than what he bought it for. In this particular example, he makes a loss of $20. When the price increases too much, hedge funds wish to close their position to prevent massive losses. Because the price of a stock can continue to rise, these losses can be infinitely high, as they are forced to buy the shares back at the current market price. The only way to close a deal is by buying the shares, which creates even more upward pressure, as is often referred to as the short squeeze. As the story gained more traction and more retail investors got involved, there was an additional psychological effect at play, namely the fear of missing out on this golden opportunity. All of a sudden, it seemed that retail investors found a way to make money fast from the big hedge funds, reminding me of the David versus Goliath narrative. Combining the bandwagon effect, fear of missing out, and the underlying market mechanics, the stock price increased to a high trading at $483 on January 28, coming from barely $20 in December. An important side note to make is that there were 65 million shares outstanding, of which 50.6 million are issued to the public, so-called floating shares, and are available for investors to trade. That means that there are 50 million shares kept privately. A short float can be defined as a percentage of shares in the market that are shorted in relation to all floating shares. For GameStop, this was up to 140%. This is considered naked shorting since there is no underlying collateral, which can lead to failure to deliver due to non-availability of those phantom shares and has been banned by the Securities and Exchange Commission in 2008. In reality, naked shorting still remains possible due to loopholes in the rules and discrepancies between paper and electronic trading systems. Now you may ask, should short selling be illegal? While naked short selling is frowned upon, short selling is still allowed, and for good reasons. For Belgium specifically, it's worth mentioning that the Financial Services and Market Authority temporarily prohibited short selling to protect the economy from the impact of COVID-19 in 2020. In an efficient market, the market price should reflect all available information. In that sense, short selling corrects overvaluation as it takes into consideration the price valuation from a pessimistic point of view. When Australia banned short selling after the global financial crisis, studies found that stocks subject to the short selling ban suffered degradation in market quality. More specifically, they found reduced trading activity, increased bid and ask spreads, and more increased intraday volatility. Furthermore, short sellers provide an incentive for investors to find fraud, as we've seen in the case of Enron in 2002 and more recently at Wirecard in 2020. On January 28, Robinhood, which is a popular investing app among millennials, restricted transactions from certain securities, such as GME, AMC, and BB, to position closing only. Robinhood CEO Vlad Tenev said that this was done to conform to their regulatory capital requirements. When you make a transaction, it seems like it takes place instantly. While this is partially true, it takes several days to complete. In the meantime, the National Securities Clearing Corporation expects a deposit from Robinhood to minimize the risk. With more movement, you have to bring more security. But with absurd movement like we've seen in Gamestop, that suddenly becomes a lot of money. Tenev said that day specifically they received a request of around 3 billion. To bypass these restrictions, retail investors moved to other platforms such as Fidelity, Public, and TD Ameritrade. As you can imagine, this caused dissatisfaction and led to nearly 100,000 negative reviews in the Google Play Store. Eventually, Google salvaged Robinhood's one-star rating by deleting the negative reviews. One day later, the SEC made a public statement explaining that the Commission is closely monitoring and evaluating the extreme price volatility of certain stocks trading prices over the past several days. Furthermore, they specifically referred to an action taken by regulated entities that may have inhibited investors from trading certain securities or putting them in a disadvantaged position. For many young investors, speculation is a synonym for getting rich easily. More experienced investors know that speculation is also a synonym for getting poor easily. While the story is still unfolding, it has been a great reminder of investor psychology, knowing when to walk away, the power of the masses, and the role of government oversight agencies. The aftermath? Major losses on both sides. Some people even took out loans or life savings to take advantage of the situation, but ended up losing a lot of money. Melvin Capital, the hedge fund, also reported big losses. As Warren Buffett once said, be fearful when others are greedy, and greedy when others are fearful. As always, before considering these risky activities, please do consult a certified professional to help you with your specific needs. All the information in this presentation comes from articles or studies, of which I put a link in the slide. I'm not responsible for any investment actions you may take after watching this video. Please do your own research.